Hello. Hopefully everyone can hear me. It's a pleasure to be with you today. Right, from bricks and mortar to digital is our topic. We're going to explore how FinTech is changing the banking landscape. And before we delve into that, we're going to talk about two laws, and not CPD points, but extra bonus points in the room for anyone who can tell me about these two laws. We're going to start with Amara's law. Has anybody heard of Amara's law or what it means? Go on. Tell the room if you know. Thank you.
Hi, everyone. I think Murray's law?
Amara's law.
Is that the one when technology is scaling?
Yeah, so
it's growing and growing and growing with there is a factor, right?
So it's our expectations of technology's growth.
Yeah.
And the line that we expect is a straight line. Very well done. Very well done. From when we perceive a new technology to exist, we extrapolate linearly into the future, a straight line. And at first, we overestimate technology's adoption, which is actually a much slower pace. And then in the long term, we underestimate technology's adoption and its impact. And you can see this with all technologies. The internet in the 90s was going to change our lives the very next day. But it did change our lives, but it took a pandemic, maybe 15 or 20 years later, to really have its impact. And it got to everywhere we imagined, where it infiltrated every aspect of business and human interaction, but it took much longer than we expected. And lots of the technologies we'll talk today, we need to bear Amara's law in mind. And as the hype is reaching its fever pitch about generative AI, bear Amara's laws in mind. It will underestimate how different life will be in 20 or 30 years because of generative and human-level intelligence AI. But in the short term, we can overestimate its impact, when really it will just write a few emails for us and do a few presentations. So that's our first law. Our second law is Moore's law. Moore's law you're probably more familiar with. This is the law that in every 18-month period, computing power doubles and the size of the silicon-based processor halves. Now that, in and of itself, is interesting, and Intel and other chip manufacturers have kept us on that path for a long time. But the really interesting thing is the end of Moore's law is next year. Next year, when we halve the silicon processor size again and double the number of transistors, the number of computing power elements on that chip, we will reach atom-thick walls between electron pathways. Single atom thickness, and we can't get any smaller than that with silicon, so we'll reach the end of computing power. And when we do that, the average size silicon chip in your mobile phone or in your laptop will have more transistors than you have synapses in your brain. Now, I'm not saying that is the point when a normal processor can match your brain, but we're coming close to that, the end of silicon computing power, and the point at which the average processor will be as powerful in raw processing power as your brain. So how does this technology and how do those laws relate to banking and FinTech? Well, we're going to talk about digital as a manifestation of technology in financial services, and we're going to start with digital disruption, a term almost everybody thinks they understand and is used all over the place. Disruption, this is a disruptive technology. I want to invest, I want to know about disruption, but people don't really understand it, so we're going to explore that. We're going to look at the history of FinTech, some business models, how that relates to banks, how the universal banking model has been disrupted and unbundled, how regulation has facilitated and in some senses managed the progress of FinTech and technology, and we're going to look towards the future and what that might mean for the industry. So, to understand disruption, we've got to understand what traditional distribution looks like. So traditional distribution for 50, 60, 100 years, even longer, looked like this. We had customers, in a kind of B2C model, we had customers of products. We had channels by which we reached them, and left to right, physical locations slowly became virtual interactions. We had catalogs and fax ordering and telephony ordering onto the internet and then onto mobile. But we've had channels by which we reach customers. We've got product lines, which we're selling to them via those channels. We've got wholesalers who are distributing those products. And we've got the manufacturing or related ecosystem which is producing those products, coming together to create the products that are sold to those customers. And this was limited by a bunch of factors. when you had to get a physical product distributed via this means, and pretty much all products were physical in the past, the scarcity of that product was a limiting factor. You could go and buy a hit record and the CD or the LP might be sold out when you got to the store, as well as the number of stores might be limited, and you'd have to go physically to them. So that was distribution 1.0. And let's look at how that manifests in the banking model. We had customers, we had channels, much the same as any other B2C business. We had products, current accounts, foreign exchange, credit cards, loans, mortgages, all the normal banking products. And we had this model where the optimum idea of a bank was to be a universal bank, manufacturing these products as well as distributing them via all these channels which you controlled to the customer. And the bigger the bank, the more you did to more customers in more locations, basically the better bank you were. You'd interact with other banks via centralized clearing and payment networks, and these things acted as inhibitors to you doing business if you weren't part of them. And so this was a barrier to entry for competition, and banks with slowly more and more increasing capital requirements, particularly after the financial crisis, and these closed networks were inhibitive to anyone coming in and disrupting this model. So let's look at disruption 1.0 in other industries. We have our customers, the channels get consolidated normally on mobile, and we've normally got one early mover who manages to almost, make a ubiquitous market out of that channel and makes their business model that digital distribution. And this is disruption to an industry. So you can think of Uber in this space. You've got the same customers accessing taxis via mobile instead of any other channel, and you've got one consolidated intermediary that's digital that can scale almost infinitely because it doesn't have any scarcity of product or scarcity of distribution. It can connect to everybody and intermediate between the suppliers and the customers. The products, the taxi journey, the digitized film, the digitized music is often the same product, but now digitized and distributed in this different way via mobile. And they may have many or one wholesaler. You might have the same manufacturers. You might have different manufacturers. In the music industry, of course, wholesalers that used to ship physical CDs or physical DVDs in the film industry were disrupted as well. But often the wholesalers remain. And if you think about Amazon here as a digital marketplace, the products are still the same, but the wholesalers have often got very big, as Amazon themselves, or very, very small, where you've got micro sellers selling particular products on Amazon. So they often tend to exist. But the centralized early mover is the key disruptive factor, and often you've still got your kind of interconnected ecosystem that might sit in that manufacturing layer. So the tipping points are that from the high street, the scarcity of product to supply, the product becomes digital, and via online or previously via post, you can start consuming these products remotely. And because the product itself gets very cheap when you can replicate it infinitely in a digital form, the product stops being the valuable thing, and the distribution channel and the customer experience starts becoming the differentiator. If everybody can sell you the same digital music everywhere, there's no difference in who is supplying the product, what product they're supplying, but only how they're supplying it is the differentiation. And so that mass distribution becomes possible. Banking has moved in a slightly different direction as it's been digitally disrupted. The customers are the same, the consolidation of channel is the same, the early mover, the centralized player, often a FinTech or often a neobank, a new challenger bank, a digital bank, is introducing you to products often made by themselves, but also often made by other people, be those traditional banks with new digital products or new digital-only products. And Starling and Monzo in the UK, pioneers of this neo-banking model, or you can think of WeChat Pay in China, have all got this model where they're introducing you into an ecosystem of other people's products facilitated by the person who's got the relationship with the customer. And the current account, the main bank, has often become the person who holds that relationship, and other products like borrowing, foreign exchange, payments, maybe mortgages are introduced to you, if not provided by that bank. And so you can see these products are feeding up. And this is what we mean by unbundling. This is what people have referred to it. And the separation of those providers of those products into their component elements, not having one universal bank doing everything, has been the first form of disruption that we've seen in banking, but it hasn't yet disrupted the banks. They're still there, they're still people's primary relationship, and they're still people's primary port of call. So we haven't had the revolution in banking and fintech that we've had in other industries. So the tipping point that we might be waiting for is not only that removal of branches and physical products with wet signed contracts for mortgages, moved into a digital product that can be consumed remotely, app-based applications and decisions, but maybe we're waiting for what's happening now. The data of those digitized products, supplemented with AI, becomes a means by which the distribution of financial products can be made intelligent. So that when your spending behavior exhibits that you're about to have a child, your bank is already offering you, or the fintech provider is already offering you, anticipating that outcome in your life as a result of changes in your spending behavior. Suddenly you're buying a pram at Mothercare, and it shows in your bank transactions. They're anticipating that you're going to need a college savings account, and they're already offering that product to you. Suddenly they're going to anticipate you're saving for a deposit for your child's home. Whatever it is, they can begin to anticipate your needs because of the data they've had about you. And we've always had that data, but banks have been really bad at doing something with it. Just checking I've covered everything I'm supposed to. Good, okay. So, in other industries, we saw the digitization of product with DVD or with MP3 in the music and film industry. We saw the consolidated central player in Netflix and iTunes. We saw the commoditization of that product and the algorithm, the distribution, the intelligence with which that product was distributed become the differentiator. That's Spotify taking over from iTunes. That's Netflix and its algorithm now taking over from its old DVD distribution business. And now we've got AI tailoring those things to you. You must have seen AI music being produced with artists that are long since dead, singing other people's songs, produced by AI, tailored exactly the artist singing the exactly song you want. Or in Netflix, they've started experimenting with ability to choose your own story or to have AI adapt the story to your preferences as you're watching it. These things are coming, and the data that they hold about you from your habits is going to help to define these services personalized to you. In banking, we've seen digitization take a similar, I need to go back. There we are. We've seen a similar trend, digitization of the process and some of the products, often via CRM, online application forms, into digital decisions about pricing, about credit, into intelligent distribution beginning to come online with AI now. And that could move into a similar concept. These dynamic products produced by AI that tailor themselves to your needs, like the music that caters to your taste. You could have a banking product, let's imagine an overdraft for a business when it's small, that becomes a revolving credit facility that involves invoice finance when they need it, and has all this optionality come online as their sales grow, their working capital needs grow, and the product itself can adapt itself to their needs. That's the kind of banking personalized future we can imagine, parallel to other industries, but it hasn't happened yet. So, what is a fintech and how are these businesses helping in this space? They normally have a dominant technology, and the fintechs we've generally seen are doing exactly the same products and services you've seen previously, but they are doing it via a new channel. Their technology is disruptive, as well as that channel, which is digitizing and making remote the consumption of the relationship with the customer. They've normally got a very clearly defined value proposition. We are concentrated on customer experience. We are concentrated on how quickly your payments are made, how cheaply your FX is conducted, and they're often focused on the customer in order to win market share. They've often got unbundled and very defined, quite narrow product sets, and their revenue streams take a variety of forms, which we'll look at in a moment. And they are either B2B, B2C, or B2B2C, often being fintechs to help banks distribute to customers, but they're not often doing all of those at once. So let's look at the evolution of technology and fintech in the banking and financial ecosystem. First, we had physically valuable currencies in silver and gold, moving to our technology of the day, paper. Some 3,000 years ago, there's evidence of paper money, IOUs representing money that you might be able to exchange for that gold or silver. We had computerization in the 60s and 70s, magnetic debit cards, ATMs came online, electronic funds transfers in the 70s and 80s, and online banking in the 90s. We move into the more modern day with mobile banking, faster payments, meaning instant money settlement not only in one's own country but around the world, peer-to-peer transactions, meaning that banks don't need to necessarily be the party you're borrowing from the internet. People started joining together, people who wanted to lend money and people who wanted to borrow it together so they could interact directly. Neobanks started coming online with their mobile-only service. Obviously, smartphones and 4G catalyzed all of these services and gave the stimulus for Asian, African, and European FinTech. And e-wallets and tokenization and blockchain and AI are now creating the next wave of FinTech. And you can think of these things as FinTech 1.0, kind of 2.0 in the 70s to the 90s, and then the noughties onwards is FinTech 3.0, the phase we're currently in. And until AI takes over, we're probably then reaching FinTech 4.0. So the traditional infrastructure and the payment networks, as I said, have been the barrier to competition and innovation in this space. But where in Africa and Asia we haven't seen the traditional banking ecosystem emerge with scale nationwide infrastructure, what we've seen instead is mobile-first infrastructure from telcos or from smartphone apps take its place. So M-Pesa in Africa or WeChat Pay in Alibaba, Alipay in China have replaced the need for banks and payment networks because they've done it all with telco on smartphone applications. And this has led to their FinTech being called TechFin. Technology companies leading into financial services that then build these ecosystems of super apps that can control almost every aspect of your life and your interaction with many businesses. So the business models by which these people make money, transaction-based models, card payments or FX payments are a good example of this. Often subscription models tying you into a value-add service is very common. We see the freemium model, where the basic service from a fintech or a neobank is offered to you free of charge, and they try and upgrade you with value-added services that, again, you probably subscribe to. Marketplace models, where they've got this baseline of product and functionality, and then they introduce you and cross-sell you into other products and services, that unbundled services distributed via marketplaces. We see in the technology space, services being provided to other banks or other fintechs on a licensed SaaS or banking-as-a-service basis, and these are really technology providers facilitating growth. And you also see traditional banking, where net interest revenues, deposits against lending, and the marginal difference in what you charge between those is your revenue. In the asset management space, in the investment space, asset management fees, sometimes transaction fees, are still taking place. But now, with Wealth via Nutmeg, your investment decisions are being made by AI, not by a fund manager or an individual. So how has regulation prompted fintech innovation, and how has it facilitated it as well as curtailed some of the banking activity that would be its natural competitor? So we're going to look at the EU, and we've got UAE equivalent regulations, which have come online much later but have performed the same task. So the first Payment Services Directive sped up payments from 3-day clearing cycles to what were 1-day clearing cycles in the EU, and that moved money around much faster and stopped banks making money in the meantime whilst they held onto your money between paying it from one bank to another. The second EU Payments Directive created open banking, which happened first in the UK, where APIs allowed data sharing from banks, your transactional history and your profile history, and allowed initiation of payments by third parties. This spread to the EU via the second Payment Services Directive and has now come to Canada, Mexico, Brazil, Australia, and many other nations, including our neighbors in Bahrain and Saudi, have also launched open banking regulations, which are very similar to the second Payment Services Directive. E-money came online in 2010 in the EU and recently came online in the UAE, and this allows non-banking players to hold money and pay money. Here we've got the Stored Value Facilities Regulation, which is our equivalent. Regulation of crowdfunding, peer-to-peer investment in companies from individuals on a retail basis, selling small amounts of shares to individuals, again regulated in the EU, not yet regulated here in the same way. And now we've got crypto assets being regulated. The MiCA regulations in the EU, coming online in the UAE with VARA and other crypto regulations as money itself has become to be digitized and distributed in different ways, and money itself is undergoing a kind of digital disruption of its own. So we've seen how digital distribution and propositions affect the evolution. Intelligent distribution and engagement, the AI sort of saying what products you need, at what time, at what price, at what credit limit you can afford will be the next step. AI decisioning will replace humans in banks, and this will lead to embedded finance. The idea that in your Uber transaction, your 𝐄𝐲𝐢𝐭𝐢𝐨𝐧 transaction, your card on file is happening in the background and making the payment for you when you get out of the taxi. You're doing nothing other than just passively facilitating that transaction by doing the thing you want to do. You'll begin to see that concept, facilitated by open banking and other formats, take place in many aspects of your life. Your travel agent will arrange for the foreign exchange, arrange for your travel insurance, and arrange for a buy now, pay later plan to fund your holiday at the point you're booking it, and those services of finance will be embedded into the travel agent experience. You can imagine a similar ecosystem for home, or for education, or for medical care, and embedded finance will be this kind of background, elegant financial services existing whilst you're living life or conducting business. This will lead to real-time banking, real-time payments, of course, with faster payments, and now instant payments becoming the standard around the world, and that will lead to real-time banking services, as I say, iterating via AI, and the conclusion of that model is the dynamic products we spoke about earlier. So for you guys as leaders in businesses, in banks, in fintechs, understanding this space, how do you navigate digital? How do you cope with the digital disruption? And how do you facilitate it in your own organization? Leadership from the top is going to unlock the smallest process. You have to be dedicated to making this transformation and demanding digital-first perspectives and initiatives on every single thing you do. Legacy culture and the inertia in an organization that's against doing that digitization or sees it as some other project to do with IT whilst I get on with the real work over here, if you don't digitize every aspect of what you do, starting with the big process and leading to the small, if you don't insist upon it, the culture will be the inhibiting factor. The technology is now there to do and achieve anything you want. Any automation, any efficiency, any AI basically you can dream of is now possible, but the culture is going to be the thing that gets in the way. Wholesale transformation of your entire organization, your entire technology stack takes time. Adding a digital signature to a manually produced document on Word or PDF doesn't take time and immediately impacts your customers. So you can add value very quickly, even if integrating DocuSign into an automated document production system connected to your CRM takes much longer. If you're not agitating and annoying your staff, your status quo, how your business operates today, you're not doing it right, and if you're not using strategic partners and technology partners strategically, you're not getting the value from the ecosystem that exists. You've got to protect the core of your business, probably the bank, and you've got to incubate the new whilst you build it to probably take over from the core. These dynamic products we talked about aren't going to instantly become everyone's normal banking product, but we've got to insulate them, get them to the people that want them first, learn and experiment before they take over. And so finally, looking towards the future, there is a sort of battle pending and a battle that's playing out in many jurisdictions around the world. Will closed loop or open loop ecosystems win? So closed loop systems are the PayPals of this world, an e-wallet that also does foreign exchange, that can hold money in many currencies in many countries, that can also do e-commerce transactions, that can also do direct debits, that can also operate as a business lender, and is keeping the products and those value-added services around its payment network and its e-wallet system. WeChat Pay operates in a similar way. You can do anything, but as long as you do it with WeChat Pay. Whereas open banking, initiated in the countries where these banks are present, in Saudi and in Bahrain, in the UK, in Mexico, in Brazil, is creating open loop systems where anyone can make that payment, anyone can provide that insurance, anyone can do that foreign exchange, anyone can provide that loan, and it's the consumer's choice in a competitive open marketplace at the point they need that service, which will define what wins. And India have done something really interesting with this. They've taken their instant payment service UPI, which is an open loop system, and they've added on a competitive real-time credit, which means you can go to the till when you're buying a TV, enter and share your data as an individual, and get real-time credit offers of who wants to lend you the money to buy that TV, buy now, pay later, you know, on credit with repayment, with interest, without interest, at the till in real time. And that is what financing is going to be like, happening in the background, automated, offering what you need when you need it. So we've done that at a tremendous canter, so feel free to ask me any questions afterwards. We've got the quiz to get your CPD points, and I'm just going to make sure that we have covered all the content. I think we have. So, on that note, thank you for the canter. As I say, feel free to speak to me afterwards. I'll answer any questions you've got, except for the CPD ones. And best of luck. Thank you very much.